Today, we're going to talk about financial investment planning, post-retirement planning. And most of the people probably would have seen Jay Marippan, Ganapathy, who's Mari. He's been actively helping a lot of organizations and also giving a lot of these seminars that helps a lot of people. I'm sure many people are aware, but I'll just give a small introduction about Jay or Mari, as we call him. And so he's the founder of Samatwa Wealth Management, and also he's an independent financial and investment advice. So whatever advice he's giving today, is take it and do your own analysis and. Fetna is not directly or indirectly affiliated on this, but he's doing a help to all the people, and we wanted to help the community as well. On that intention, this is being done. We just wanted to make sure everybody's on the same page on that. And also, he holds a MBA in finance from John Hopkins, and also he's a chartered financial analyst. And he was working as a director of Xerox in the past. And he's done his undergrad from CIT, Coimbatore Institute of Technology, and PhD Tech, Coimbatore. Just wanted to also talk about roughly what we're going to be covering today. He's going to go into details in the number business tax strategies, Pati. He's going to go over and personal some tax strategies and estate planning, bills and trust, NRA fund, and also NRE, NRO related differences and some capital gains related topics. And the main thing we're going to be doing it in probably 4 sections. And so after the first section, it's going to be like a 5-minute gap where we'll open questions. And then you can continue to post your questions in the chat. We'll keep a tab of all of that. Kadasila we'll have open up for questions where you can go back and forth on many things, right? But the idea is to keep 5 minutes after each topic or section, just so that we can have some questions that are relevant to it right away. But when it goes beyond 5 minutes, we're going to hold it till the end of the session. That's the plan. So I'll hand over to Mari, and thanks a lot for doing this, and welcome everybody. Thanks. Go ahead, Mari.
Okay, sorry. Can you hear?
Yeah, we can hear you.
Okay. எல்லாருக்கும் வணக்கங்க. First of all, I would like to thank you, FETNA, for providing this opportunity. So today, our எழில் சொன்ன மாதிரி 4 topic I'm going to cover, important topics. Okay. So the first topic is going to be the family financial risk. உங்களுக்கு எல்லாருக்குமே தெரியும், நம்ம as of today பார்த்தீங்கன்னா நிறைய GoFundMe போயிட்டு இருக்கு. So I want to share whatever I learned so far, almost more than a decade of learning. So I would like to share with our community and make sure that every one of you guys follow. And then the next topic is about college financial planning. எல்லாருக்குமே kids probably school இருப்பாங்க. At some point they're going to go to college. So I'm going to cover that. Then the third topic is about the NRI fund repatriation. Either from assets India sell பண்ணி transfer பண்ணி கொண்டு வரது, இல்ல maybe for whatever reason people who are moving from the USA to India. அதுக்கப்புறம் then we'll talk about all the tax strategies, investment, and the post-retirement. So first, let me start with the importance of involving spouse as part of the financial planning. Actually, before I get into that, I would strongly recommend every one of you actually married, and please request your spouse to join this session, at least for 30 minutes. I think I'm pretty sure definitely will be helpful. Because what I'm so far observing in our specifically whether a Tamil community or Indian community, 90% I would say only men or husband are handling the finance, right? Even when they come for the meeting, client meeting, like advisor meeting, they don't bring their spouses with them. So that's why I'm just reiterating why it's important. So if you look at whatever reason, right, if a family lost the breadwinner, and then the spouse has to do a lot of things. Let's say if the spouse is in a dependent visa, right, then immediately they have to hire an attorney to try to get some temporary protection status, right? And so for that, they have to gather a lot of documents. Then the next thing they have to do is, let's assume they have a home and mortgage loan pending, then they have to put a pause on that. So they have to reach out to the loan servicer and temporarily put a stoppage. And then they may have to reach out to the Social Security, start the survivor benefits, particularly if they have a minor kids. Then contact the life insurance agents and start the claim process, right? Assuming the husband sign up for either the outside term life insurance or through the employer term life insurance. Then the next things they have to do is reach out to the employer HR for their husband, and then discuss the plan for transferring the 401k, because the 401k will be converted into inherited 401k. Then there are different rules applicable for that. Then probably the husband might have some IRA or Roth IRA, brokerage accounts. So all those things, so now it will be under the spouse custody. Then the spouse have to handle that without any tax complication, because if they make some wrong move, then potentially they can pay a lot of taxes on that, right? And then the next thing, once they get a job, then they have to start handling the bank accounts, credit cards, fund transfer, even handling mortgage, filing taxes, managing all the retirement account, brokerage accounts, investing the short-term cash, real estate, or any business, or managing assets in India, manage the kids' college financial planning. So I can just go on and on, right? Because the finance is very important for it's a personal finance, right? It's very important for each and every family. And because of the lack of information, and they can easily get scammed. And I have seen it, right? So that's why it's very important. So please start involving your spouses from now. Just nudge them, encourage them, and just participate them. Ask them to participate whenever you are doing any financial related changes or major financial decision. Involve them, because what I am finding is many of them, even they don't know how to log into 401k or even to a small allocation change, because they completely give that task to their husband. Because at some point, as I said, that they may have to handle all those things. So that's why it's very important. I know traditionally it's our probably our Tamil culture or Indian culture, it's predominantly men handle the finance. But I think we kind of, our first generation moved here, and we don't have that kind of social connections we have like back in India, whether parents or relatives. It's not here. The support system is not here, unfortunately. So that's why it's very important. So you have to accept that, and then take some actions going forward. I think taking the action as soon as is better. I know some of them tell, okay, I share user ID password. That is good, right? But at the same time, just encourage them. Again, it's not going to take much time. They don't have to spend a lot of time on this. Even just a few hours or half an hour every month or every quarter or every year. I think just get them involved. I'm pretty sure they are smart, and everyone is working in IT and holding big titles, and this is not a rocket science. And all you need is fifth grade mathematics for learning this business personal finance, right? Okay, then move on to the family financial risk protection. So this is another unfortunate thing in our community. Every day, the GoFundMe, it's happening every day. Even I've seen today. It's very sad. So how to avoid that, right? We can take very easy proactive measures, and it's not that expensive. So I recommend for every family, if you're married and if you have a minor kids, take outside term life insurance. So I recommend all we need is just the right term life coverage. That's all we need. And you can get the codes from, there are a lot of marketplace there, like Select Quote, Term for Sale, Policy Genius. You can get the quote. Let's say if you are in 30s, 40s, I would recommend you can go for maybe 30-year or even 35-year or term life, and get it from good rated companies, right? Make sure that they have a good credit ratings, good customer service, good claims acceptance rate. Don't just go by just the price, because if you go for if it's maybe a cheap, but down the road, let's say the company might bankrupt, right? Then it doesn't serve the purpose, or their customer service is very bad. They simply kind of keep dragging the beneficiaries and are not basically refunding the claims. So that's why it's very important to select the right term life insurance, and for the term perspective and also the amount. So the mistake what I'm seeing is many of them only have the basic life insurance with their employer, which is basically it's 100K or 200K. So definitely it's not enough. And some of them tell, okay, I'm an H1, I'll go to India, but I have a LIC. Okay, how much you have? They'll say, okay, I have 25 lakhs. Come on, the 25 lakhs is nothing. You are living here, right? So that's why at least you need a 1 million, 1.5 million, or 2 million. So the reason is simple, right? You might have a pending mortgage that would be 500K, and you might have 2 kids, and you know how costly college education, right? I'm going to cover that next. That for 2 kids, it can be easily anywhere from 250,000 to 500,000, depending on in-state or out of state. And then at least you need to cover 5 years of family expenses. And you have to include any other pending loan. So if you add all those things, definitely it'll be in a million. So in order to get the right coverage, I strongly recommend, so you need to have at least 1 million or 1.5 million. Again, depending on your age, the premium for the term life, it's not that expensive. Anywhere if you're, let's say from age 30 plus to probably 40 plus, anywhere from $50 to $150 for $1 million policy. And for women, usually even it'll be much cheaper. I've seen maybe like even $30 or $80 like that, right? So, so again, to reiterate, if you haven't done it, make it as a priority, do it as soon as possible. And then in addition to that, talk to your employer, check their benefits, because I'm seeing a lot of employer, they are also offering supplemental or voluntary life insurance in addition to the basic life. So I would recommend sign up for that also, because it's not that much expensive. So by having that also basically adds and provides better protection, right? Because the cost you are spending probably like a 10 Starbucks or 20 Starbucks, right? But at least the upside, Tamil சொல்லுவாங்க வருமுன் காப்போம், right? So that your upside is it's very good, and it protects your family. Okay? And then the next important thing for family is will and trust. So my recommendation is, at a minimum, if you have a minor kids, at least set up a will. So by doing a will, you can nominate a guardian and executor for your a minor kid, so that they can take care of the custody. Because in US, if something happened to both parents, then the custody will be decided by the local county court. So they can basically send your kids to any foster care. But if you have a will and a nominated the guardian and executor, so they will get the custody. So now the question is, okay, who should I assign, right? So I strongly recommend at least select or assign the guardian who is from your local state or within US. So it could be your close friends or relatives are here. Because the reason is, if let's say if you assign primary guardian as a person in India, but whatever reason, if they couldn't travel, which we know it happened during the COVID, many of them couldn't travel for 6 months or a year. So that's why it's important to find a person, assign them as a primary guardian or executor from here. But you can also assign them backup, multiple alternative too. So you can definitely assign your parents or relatives from India as a backup, and make sure that they have a visa, or they can easily get a visa, and they can travel and come to US if necessary, right? Then setting up the will also, it's not that expensive. Again, many employer offer legal benefit plan. And if you sign up, they charge like $5 per paycheck. And using that plan, similar to like medical insurance, you hire basically a doctor, you find a doctor and get the medical service. Similarly, the legal services, you can hire an attorney through your benefit plan. And then with their help, you can do this will and trust. Then the other option is, again, you can hire your own attorney, and they have to be a local estate attorney licensed with the local county code. Make sure that, so they can help you to set up this. Or if it's not that complex, you can also buy the online software and then create it and get the witness and notary signature. Okay. And then beyond the will, there is also another tool called a trust. So there are two types of trust. One is a revocable or irrevocable trust. So assuming if you have a lot of assets, but because by having the will, it does take care. But the one issue with the will is you still have to go through the probate process. So the probate process means you have to hire an attorney, right? If something happened to the grantor, then they have to go through that probate process to basically get the assets under the control of the executor. So then they can give it to the beneficiaries. But if you set up this trust, let's say a revocable trust, a living trust, it completely avoid the probate process. So you don't have to go through this probate process at all, because you are the grantor. So basically you are granting all your assets under the trust, because you set up the trust and you fund the trust. Let's say you, if you have a home, primary home or investment property, you'll do a quitclaim deed and then transfer the ownership of the asset under the name of the trust. So as long as you are alive and you will be the trustee, then you will nominate the beneficiaries, that will be your kids. Then you will be also nominate your successor trustee. So that could be similar to your guardian and executor, the person you trust, so that if something happened, then they will be the trustee. And then until your kids are minor, they will have the custody. Then after that, then again, you can customize the trust any way you want. You can tell, okay, the trust will basically will go to my kids. They'll inherit the assets maybe at the age of 22, 30 or whatever that. So you can kind of decide specific to your family situation. Because by doing the trust, it also eliminates the additional costs involved during the probate process, because many states, because of the local county court kind of backlog, like for example, in California, New York, I heard it takes months and years, this probate process, and also it's pretty expensive too. But if you're doing this will and trust and upfront, again, I don't think it costs that much. So that I would definitely at least set up the will if you have a minor kids. Okay. Okay, I think we can, so Elil, we can pause for maybe 5 minutes, take questions before go to the next topic.
Sure, yeah. So Jay, I saw two questions so far, and I think if you know, one is about can we have more than one guardian, which I think you kind of
Correct.
addressed.
Yes, absolutely. You can have more than one guardian. Yes.
Yeah. And then the other one I see, the last one, if you can maybe read it, I don't want to translate for you. I don't want to confuse it. The last one that was posted, I'm new to the States in less than 2 months. I want to get started with my investments. Can I get help from this group for my guidance? First, I want to start SIP kind of thing. That's what he has posted.
Yeah, so I think in the slide, you have my contact number and email. Yeah, definitely you can reach out to me offline. Yes. Yeah, you can do similar to SIP here also. Yes.
Yeah. Should we open it up in a way that they can openly ask the question, or you want to just read it from? I can read it from the chat. How do you want to do this?
Recommend, yeah, let's read it from your chat.
Yeah, I think that's
at
better.
the end
Yeah,
we can open it up.
Yeah. Okay. Perfect. Yeah. Okay. So again, another question from Raj. It says, setting up a trust in one state, and if we really does the process and information get re-updated?
Yeah. So if you move from state to state, typically your will have to be redone, because the will is specific to the state estate laws. So that's why you have to redo the will. But and I think the trust it will work. And you can have a multiple trust also if required. If you have assets in different states, you can do it trust based on that state also. But you don't have to redo the trust per se.
Okay. Another question from Srinivas. It says, is there a requirement for minimum wealth to establish a trust?
No, there is no minimum requirements.
So, and Ashok, I'm not sure the question, it says hundreds of tens of thousands. Is that a question? Okay, so approximate expense. So what's the approximate expense to for a will in a trust?
Yeah, so as I said, if you do it through your legal benefit plan, probably it'll be less than $100, right? You're paying like $5 per paycheck. And if you hire some professionals, typically for will, it'll be, I would say, maybe closer to $500. And then if you hire an attorney for a trust, typically anywhere from $3,000 to $4,000 they charge. But if you use the software, you can probably done it less than $1,000.
That's all the question I saw so far. I think, okay, there's one more. Let's just take this and then you can go to the next section. Can I upgrade my term insurance from 500K to 1 million? Currently paying close to 800 per year.
Yeah, so probably you have to talk to your insurance agent and find out whether you can upgrade, or you can take like what they call is a ladder insurance, right? So you can take another 500K separately also. So that's also possible.
Okay. Okay. So Srinivas, I'll keep this couple of questions towards the end, so we can move to the next section. So Jay, you can probably proceed to the next section. I'll keep these rest of the questions in the list to ask later.
Sure. Yeah. Okay. So the next topic is about kids' college financial planning. So this is as of now for this academic year, the in-state 4-year college, it's cost anywhere from this include all the tuition and all the costs, easily from $100,000 to $125,000. And if your kid, let's say, decide to go for out-of-state college, so that could be easily $250,000. Then if they want to go for private or Ivy, and it can be easily even 300 to 400K range, right? So the one thing I just want to point out, because this is a little bit different from mostly we are studying in India, right? The elder people, people in maybe 30s, 40s, 50. I don't think our parents spend this much money, right? Because our education system is different. So the value of the $100,000, right? If you just put it in an index fund like S&P 500, and by the time your kids reach, it'll be worth $2 million, right? So think about the value of the money what we are spending on our kids. Again, I'm not saying that we shouldn't spend, but I'm just saying that it's an enormous amount, right? So that's why it's very important, okay, how to manage such a huge expenses, right? Because this is almost similar to kind of your home mortgage level it's coming. So there are various tools and strategies you can work with your kid and then start work on it. So that's going to basically reduce your financial burden. So one is scholarship. So I'm not talking about the merit scholarship offered by the college. So these scholarship, it's completely outside of the college. When your kids are in high school, so they can apply for this local, state level, or even country level endowment, nonprofit type of scholarship. So there are a lot of scholarship websites there. I listed few like CHEK, CAPAX, College Board, FastWeb, Scholarship.com. So I encourage your high school kids to go to this website or do the search and find out the scholarship. If they apply for those, maybe there is a higher probability they may get it, right? And most of them, they offer maybe 10K, 20K, 30K, and even I would strongly recommend ask them to talk to their school counselor, and they will know there are a lot of local county level scholarships also available, and many of them didn't aware of it. So those are all has a very high probability. Okay. Then the second strategy is a state offered 529 plan. So that's another way you can save, because whatever you save and you can invest, and all the gains will not be taxed as long as completely tax free, as long as you use it for education purpose. And then third thing is a FAFSA. I know this may not be applicable for the H4 student, but all the GC or US citizen kids, so they are eligible. So when they are in probably in the senior years, so encourage them to submit these FAFSA form, because by submitting the FAFSA form, now they have a chance to get this need-based aid, merit-based aid, and also may get the subsidized loans and unsubsidized loan. I know getting the need-based may be a little tough because it's purely based on your income. Whether you have, I know there is always kind of a myth there. People say, okay, if you have 529, it'll impact all your scholarships and stuff. It's not true. So then the need-based or the income-based aid, as long as if your income is above 60, 70K, and most likely we are not going to get it, because the need-based is the government provide is based on the poverty guidelines. So people who are making very, very low income kids will be eligible. And then the merit based, it's completely different. They don't look at any of your other thing. So it's purely based on merit, right? And then the third thing is basically a loan, either based on the student income or your parents. So you can apply for this subsidized or unsubsidized or a plus loan. So usually like a subsidized, unsubsidized, you can easily get like $5,000 per semester or per year. So you could use that funds to cover some part of the education cost. And again, this is, remember, you're taking on behalf of your kids. So basically the kids is taking the loan, and basically it's a government loan. And I would recommend it's a good thing to do because it kind of provides a skin in the game. And so your kid, after they graduate, so they have to repay the loan. And the good thing with the subsidized loan, whatever the interest that accrue during their 4-year college, your kid doesn't have to pay because the government kind of write it off as a subsidy. But if it's unsubsidy, obviously the kid have to repay that interest. Then the repayment only start after like 6 months after the kids graduate, right? Assuming they probably get a job. And then since these are government loan, there are a lot of good flexibilities there. So that's why it's completely better than the private bank loans. So I would strongly recommend your kids to consider. And also it helps them to learn the finance too, right? By having the loan, small amount of loan, it helps them to build the credit score, and they'll understand how the interest works, right? Because at some point in their life, now they have to buy a car. For that, they need a car loan. They are going to take a car loan. Then probably at some point they're going to buy a home. Then they will take a home loan, right? So this is kind of a pre-run, I would say, so they can kind of learn practically, right? So I think I would strongly recommend work with your kid and then consider these options. And besides that, you can encourage your kids to do AP courses. So and also getting the AP credits, then you can utilize the credits to minimize your college cost in the college. And similar to 529, there's a Coverdell ESA. Yeah, so that's another tool. You can contribute $2,000 per kid per year. And again, as long as you use it for education, you don't have to pay the taxes. And then depending on your income, you may be eligible for this American Opportunity Tax Credit. So you can get it for the 4 years for the kids while studying. But I wouldn't recommend withdrawing any money from parents' retirement accounts to use that. Please don't do that mistake. And then there is another strategy. Let's say if your kid decide to go for out of state, and we already know the out of state is pretty expensive, right? So there are ways, because every college and state has a residency classification rule. So what you have to do is, I know the first year we may not have any option, so they will pay for the out of state tuition fees. But during the 12 months, you try to work on meeting the eligibility, maybe getting the voter registration, state ID, and file the taxes. I would strongly recommend your kids, once they reach the 17, ask them to file the taxes separately, because that's going to help with their probably in these out of state situation. Because once they file the taxes and using the kind of a financial independent status, we can argue and try to get the in-state eligibility. Again, it's completely vary from state to state, but again, the colleges don't advertise this because it's they'll be losing the revenue, right? Why do they do that? So that's why it's your job to dig these detail, talk to this college counselor, find out the residency classification rules, and then work with your kid to start work on it. Because even if you can convert from out of state to in-state from second year, right? So 3 years of tuition cost you can save. It's a lot of money. Okay. And then, as I said earlier, so the 529, there are two type of 529 plans are there. So one is the prepaid, and another one is invest 529. So I would recommend the prepaid 529, assuming if your kid and you 100% sure your kid is going to study in the in-state colleges. So in that case, you can sign up when the kids are very small, so that you'll pay probably lesser amount, because once you pay and bought, because these are kind of advanced credit you're buying, right? So that even if the college costs double, triple, you will not pay any additional cost. But the drawback is, once your kid get into high school, he said, okay, dad or mom, I'm not going to go to the in-state, I want to go to out of state. Then obviously, then you cannot utilize that, right? Because it's not portable from state to state. That's the prepaid option. So in that scenario, if you're not sure your kid whether he is going to go for in-state or out of state, then go for an invest 529. So the invest 529 is kind of similar to your 401k, but you will be doing the contribution every year. Then you'll invest in some target date funds or index funds, and then use the gains from the 529 when your kids go to the college. But the good thing is the invest 529, you can use it for any colleges within USA. I know I've heard many questions. Okay, what about if we move back to India? Unfortunately, this 529 it doesn't cover colleges in India. It's very few. So I would recommend. I think if you Google the FAFSA approved colleges, then you can find out which colleges it approved. But it's very minimal. So if you're 100% sure if your kid is going to study in India, then probably I wouldn't recommend these 529 plans. But if you are 100%, if they are going to study here, then I strongly recommend start these plans earlier, right? Because the sooner the better. Because in finance, the power of compounding works when you have a more time. So particularly when the kids are in kindergarten or even 2-year, 3-year old, start contributing even $100, $200 per month, whatever you can, so that at least it'll grow. And the other benefit is there are 15 states in the US, like for example, the Maryland, where I'm in, like Virginia, they also offer a state income tax benefit. So whatever the amount you contribute, I think up to like $5K per kid or $4,000 per kid in Virginia, you'll get the tax for the contribution itself, you'll get the state income tax benefit. You will not get any IRS tax benefit, but all the growth completely tax-free from either the IRS or the state. Okay? And you can create a multiple accounts and assign your beneficiary. And let's say first kid got 100% scholarship, you can always use it for second kid or your grandkids. So pretty much you can, or you can use it for your master degree, or even you can use the money for your pre-K to 12 expenses also. So there are a lot of flexibilities there. And even worst case, let's say if your kid couldn't use that at all, based on the recent Congress law change, $35,000, you can roll over from your 529 to Roth IRA for your kid. Right? It's a completely, you don't have to pay any taxes on the Roth. You guys know that. So that's another option also available. Okay. Then the next option is the Coverdell ESA. So there is no state tax benefit for the contribution, but you can contribute $2,000 again based on your income, and you can invest in any stocks or index funds, and you can use the funds for college education. Then the another thing, a few points I would like to share with you guys. So please discuss with your high school kids, because as we discussed earlier, because the college cost is pretty high, right? That's why the decision what you're going to take, it's going to have a pretty long-term impact. So that's why I think do the proper due diligence. So before you decide the college, find out what kind of program and courses they are offering, whether that what your kid is interested, right? So definitely do the upfront research. and then talk to the past students or the students who graduated from the college. Get their feedback about the faculty, their library, or their technology labs. So that way you can at least make some better decision. And also there is a website called ratemyprofessors.com. So you can ask your kid to research and find out the quality of teaching, right? Because the reason we go to college, it's purely what? To learn something, right? Paying $100,000, $200,000, and if the kids didn't learn nothing, that means it doesn't serve the purpose. Then make sure that the college has a great alumni network, because that's going to open up good internship and job opportunities for your kids. And then find out their quality of education compared with the other colleges what you're applying. And then the most important thing is find out estimate the cost. Okay, how much it's going to cost the college you are going to select. And then as a family and discuss, okay, how are you going to support this, right? Have a transparent discussion with your kid, and make the right decision for your kid and your family. Okay. And then while they're in high school, I would recommend request your kids to focus on the personal development too, because which is going to help tremendously when they are in college or even after they graduate. Encourage them to attend these business conferences and build their networking, right? Because without the networking contacts, you are not going to get good opportunities. So that's why building this network, again, it takes time. So that's why I'm requesting you to start sooner. And then I request them to find internship opportunities. I know when you're in high school, it's probably tougher, but there is always opportunities there. Encourage them to find the opportunities so they can work during the summer. And then encourage them to develop the communication skills, reading, writing, verbal, because those skills are definitely you need in order to be successful in college or even in the job. And encourage them to participate in the clubs or any school projects, and provide their best contribution, because that's how they can learn a lot of things, right? Okay. I think that's all about the college section. So I think I'll stop for probably 5 minutes. Elil, we can take some questions. Yeah.
Sure. Let me just read the questions for you.
Okay.
Okay, there is a few questions. I'm going to இது சம்பந்தமான questions one day I'm going to whatever we just covered. அது சம்பந்தமான questions one day we'll talk about, and then anything related to the wills and other things we will keep it at the end. Okay, so so based on this, a few questions. So one is about the scholarship eligibility for H4 visa holders. So how does your scholarship eligibility work for children with H4 visas? Can they also receive college scholarship? This is
so I think there are still opportunities there. I think I would strongly encourage them to start applying, because a lot of the local level, state level, I don't think they'll that particular about the visa status. Because I'm talking about these are the scholarship not part of the college, right? Obviously, for the H4 student, I don't think they'll get the merit-based aid since they cannot apply for the FAFSA. But for the scholarship I talked about, I'm pretty sure they will be eligible. So I would strongly recommend them to consider that. Yes.
Sure. And so another one is about expatriating money on scholarship eligibility, about the impact. So if someone expatriates from India 3 years before their child starts college, so how does this situation increase the bank balance effect and the eligibility for scholarship aid? This is from Karthik.
Okay. So when they submit the FAFSA form, so they will ask parents to actually disclose all the assets. But the good thing is the assets you have to include your the bank accounts, but you don't have to report any of your 401k, IRA, the retirement accounts. You can exclude that, and your primary home you don't have to do that. But the income, obviously, whether you disclose it or not, they will pull it from the IRS directly, because they have the tool to do that, right? So I think by having these type of balance, again, as I said, the income based only it will impact, but neither way, whether you have a bigger balance or not, I don't think it's going to have a much impact on the income based aid. But the merit based aid, it's not going to have any impact whether you have a big balance or not. The only other thing, the ability to pay, if it's higher, then the eligibility for the subsidized the loan, the plus loan. So obviously they will you'll get a lesser loan. It may impact on the loan part probably on the financial aid side.
Makes sense. Makes sense. So another question. It's about a 17-year-old child on H4 visa, and can they file a tax independently?
Yes, they can. Well, I think they may not have a SSN, but they can get the IT number, and then
Okay.
using that they can do
Okay.
that.
Okay. So, and then if a person has a term policy in India and then moves to US, okay, I think this question is kind of from the other one. Let me just hold on to this and I'll come back to this later. So, will the Social Security deductions from paychecks be reimbursed or returned if someone moves back to India?
So the Social Security, I will cover that part of the post-retirement benefit.
Okay,
Let's
yeah,
hold on
okay,
that.
no problem. Yeah, I think it got mixed up here. So, index funds, brokerage accounts. Okay, so what's the difference between investing in index funds through brokerage accounts and the PA 529 plan?
Yeah, so the 529 plan, so they all offer some preset of funds. So you can only go by that. So as I said earlier, so they probably provide like a enrollment-based funds. Let's say if your kid is going to enroll, graduate or starting the first year in 2030, then they will have a fund called Enrollment 2030 Fund. So there is a option, so you can basically direct your funds or your contribution to the enrollment fund, or they also provide the index funds like the S&P 500 or the total stock. So you can do that also. But when your kids are getting closer to college, probably you may have to move it to kind of a less risky fund, like a short-term money market or like a stable funds, so that if the market crashes, it won't impact your 529 funds, so that you can use the funds for your kids' education.
Two more questions and we'll go to the next section. So this is about, again, 529. Possible to withdraw money from a 529 plan if plans change and the individual moves to India?
So yeah, as I said, if they move back to India and if they are 100%, if the kid is not going to study in the USA, so you have two options, right? After 15 years of the 529 start, then you can move that up to $35,000 per kid, move it to the Roth IRA under your kid. Then after that, after 59, you can withdraw, so that zero loss. Or if you want immediately withdraw, then you can, even though it's not for education purpose, but you can still withdraw the funds from 529, but you'll pay 10% penalty and the taxes for the gains from 529.
Okay. Okay, sure. And the last question, well, there's two questions. So is a 35K contribution to a 529 plan a one-time or a recurring amount?
It's you can recover, but the total has to be 35. You can do it one time
Okay,
or recurring. Yeah, you cannot go. The maximum is 35.
Okay. Okay.
For the
The last question: are there any financial benefits or breaks for twins attending college in the same year?
I think it may, depending on the colleges, but I don't think, from whatever we discussed, I don't think so. I know some colleges may offer the sibling discounts. I think you have to talk to the college financial counselor and find out if any opportunity comes, any opportunity is there for saving.
Okay, Jay. So there are more questions. What I'll hold on to them and then ask at the end, so we can go to the next section, so we can keep a tab on the time.
Okay, sure.
Yeah, thanks.
Okay, so then the next topic is mainly for NRI. So I'm going to just cover two segments. So one is for the NRIs who want to sell their real estate properties from India, because these are the folks like me, like moved 2 years, maybe like in 1998 or early 2000. And then they heavily invested in India because the thought process was, okay, we'll probably go back to India. But now they are all settled, they have kids, and the kids also settled here. So now they've decided that, okay, they're not going to going back to India, right? So in that scenario, so once you decided if you're not going to going back to India, if you're going to settle here, so for those, I think I would strongly recommend come up with a plan to basically manage these real estate properties, because the challenges what I'm seeing is the first one is since the parents are getting old, and it's difficult for them to manage the properties in India. So that's one difficulty. Then the second thing is it's the lot of bureaucratic process, because for selling this process, there are a lot of steps involved. And obviously, while you are living in USA, you cannot make a lot of multiple trips and manage and sell these properties. And then the next thing is, even if you sell these properties, right, the biggest problem is again the loss in the exchange rate, because when they bought the property, maybe that time the dollar was maybe like 40 rupees, but now it's like 80, 85 rupees, right? The depreciation, the dollar, the rupee card lost the value, so that they are taking a hit on that. Then the another thing is, unfortunately, when you sell, because of the guided value concept, because they actually put a lower amount when you sell the property officially. So you can only transfer that money to US officially, right? But the other money, unfortunately, you cannot repatriate. So that's the another biggest challenges. So these are the kind of ground challenges we are facing. But I'm quickly going to talk about, okay, once you sell the property, how to repatriate the funds, the actual funds, as per the paper. So as an NRI, so you need to have a tax ID from your India. So that's you have to apply for a PAN card. Then assuming if you couldn't go there and sell the property, then you have to draft a power of attorney and then give it to your trusted family members, maybe your parents. And then you have to do the sale agreement with the buyer. Then you have to find out calculate the capital gains, because the rules are different in India. So in order to calculate the capital gains, so you might bought the property maybe, let's say maybe 80s, but the cost base is you have to start from the January 1st, 2001, as per the rule in India. Then based on that capital gains, then you have to pay the taxes, right? But in India, the way they are doing is, when you sell the property, right, they withheld the TDS, or tax deduction at source, usually probably like 22, 23%. Sometimes if the property is in crores, they will also add surcharges. So they do that upfront. Then you have to file taxes to get the a refund of the excess taxes you have paid. Okay. Then if you decided to repatriate the funds, so once when you sell the property, it will go to the NRO account. Then you have to work with a chartered account in India, file the 15 CA, CB forms. Then you can repatriate the funds from the NRO account to either to the NRE account, or you can actually directly bring it to your US bank account. Then once you bring it here, then you have to file taxes in India, right? Then you have to work with the CPA here also to report that income. And plus, if you have a cash, probably since more than $10,000, then you have to file the FBAR also. But the good thing is you don't have to pay taxes in both countries, because India and US are part of the double taxation treaty. So if you, since India capital gains taxes are higher, so since you already paid a higher tax, so you will show that as a foreign income tax credit when you file taxes here, when you report that income. Okay. Then, so this is for the investment property. Let's say if you have an inherited property from your parents, then obviously you're not going to incur any taxes, even though you pay a TDS, but you file taxes, you completely get a refund because it's an inherited property. But here, obviously, then you have to pay the taxes in the US. Okay. And then other option also available is called gifting. So let's say the property is not under your name. Let's say if it's under your parents' name, so technically they can sell and then they can gift the money to you. So as per the IRS, you can bring $100,000 from India as a gift, but you create a gift deed to record the transaction so that later on if any query comes. So you don't have to pay any tax liability on that. Okay, so those are the important points. Again, as I said, definitely you have to have a good chartered account if you decide to sell some property in India and repatriate money, and also you have to work with the CPA. And as I said, it's going to be, we all know the bureaucratic process involved back in our country. So it will take a lot of time, and you need patience to go through this process. So that's why it's very important, do the planning now. Think about your kids may go and handle this. That's the probability is very, very low. Even for us, it will be very, very challenging to do that. So all I'm saying is have some long-term plan, then gradually do the thing so that you can move the funds here. You can use it for either for kids' college education or reinvest in real estate or any other objective based on your family needs. Okay. Then the next thing, this is for the NRIs who are returning back to relocating back to India. Unfortunately, we all know because of the most of our folks are working in IT. I know the market is pretty bad for IT since the last year, even though the overall economy is doing very well, but particularly the IT sector is going through a lot of layoffs. And so for people in H1, if they couldn't get a job within 60 days, then unfortunately they have to go back to India. So whether it's voluntary or involuntary, if you decide to go back, whether you're a GC or US citizen. So there are a few things I want you guys to consider based on the long-term benefit, right? So the one thing is, if you're already worked 10 years here, I'm pretty sure you met the 40 credits eligibility so that you're eligible for the Social Security credits. But if you're closer to the Social Security credit, let's say maybe you worked 8 years, 9 years, I would strongly recommend try to find a way to work maybe a few more years to meet that eligibility. Even if you couldn't do it now, you can come back anytime. Maybe for short break, a couple of years, come back and work and meet that eligibility, earn the credits. And then you may have a primary home or investment property. So instead of completely selling and moving, you can find some trusted friends or property manager and to make it as a investment property. So that way you'll produce some stable rental income, you'll get the exchange rate benefit, and then also build an equity over the time, right? So I would strongly recommend to consider that option. And also definitely you may have a 401k, IRA and broke investment accounts. Again, if you have a small amount, it's not going to impact much. But if you have lived maybe 5 years, 10 years, probably you have a very decent portfolio. So if you sell everything, you are going to incur tremendous taxes, because like a 401k, let's say if you're going to India, if you withdraw 100, 200K, you're going to lose immediately $30,000-$40,000 because a 10% penalty and 23% on your income taxes. It's a pretty huge loss. So I wouldn't recommend doing that strategy. So instead of that, I would recommend after you move to India, maybe gradually, because again, it's your fund. Anytime you can use it, okay? Nobody's going to steal these funds because it's your money. And you can do a Roth conversion gradually, because once you moved, assuming your taxes are not going to be here, then gradually do the Roth conversion. Then after 59, you can completely withdraw without any taxes here, right? So there are a lot of strategies you can try to minimize the taxes. And again, all these things, for example, the Roth contribution, whatever since it's after tax, so you already paid the taxes here. So you're not going to pay taxes in India for that. But obviously, let's say if you have some gains in the Roth account, because here after 59, when you withdraw, it's completely tax-free. But if you move to India, but when you withdraw, obviously the gains, you may have to pay the taxes in India, because as I said, because of the double taxation treaty, at least either one country, you have to probably pay the taxes, but likely not to the both countries. Okay, and if you have any businesses, you can run it from India. I've seen many people who migrated back to India, but they are still running the business, their businesses, LLCs, S Corp, C Corp from India. Okay. So I think in summary, the main benefits are the exchange rate. And later on, for whatever reason, again, let's say you decide to come back to USA, at least the disruption will be very, very minimal for you, right? And you can set up a Google Voice and for getting the OTP numbers, and you can manage the accounts. You set up a two-factor or multi-factor authentication, and you can manage it from India. And another thing is, even if you move back to India, work with a chartered accountant, because in India, the tax rates are 30%. It's pretty high. So there are a lot of strategies in India too. So try to minimize the taxes as much as you can. Okay. Okay. So I think we can hold for maybe 5 minutes before we move on to the next topic. Elliot?
Sure, Siva. Okay.
Yeah.
Let me just read the questions. We may miss one or two here and there. I'm trying to do justice, but we'll do it at the end. I'm just trying to keep it track. Okay, so couple of questions. It's any specifics on 529 to a Roth conversion? I think a little generic opinion, but that's all they mentioned.
I'm sorry, could you please repeat the question?
It says, what are some specifics to 529 to Roth conversions?
Oh, the specifics are the eligibility is you have to meet the 15-year rule. So in order to move the 35K from 529 to Roth, so that the date of your first contribution, right, it has to meet the 15-year eligibility. So after 15 years from your very first date of your contribution to your 529, then you can move the 35K if you have it in your 529 to Roth IRA. But again, to your kid, not to your Roth IRA.
Okay, so the next one is from Bala. It says there is a Roth IRA you had mentioned, and can we withdraw from that for college education? And any restriction or penalty charges to withdraw based on an age?
Yeah. So for a Roth IRA, you can withdraw just the principal, since it's after-tax contribution, just the principal what you contribute after 5 years, and you can use that money for college purpose. But the gains, if you withdraw, then before 59 and a half, 59.5 years, then you have to pay the taxes plus the penalty will be applicable for the Roth IRA also.
And so this is about a student employment and federal work study. I couldn't figure out this question. It's kind of
okay. Or we'll take
I'll
it
come
at
back
the
to it.
end.
Yeah. Okay. So is there any alternatives to 529?
Yeah, so that's why I covered in my session, right? So other than 529, so you can also try the Coverdell, or you can also try the scholarship options or the other loans, subsidized, unsubsidized loan, or definitely submit the FAFSA, doing the AP credit. And I've seen the other strategy also. Your kid can study in the community colleges for 2 years, because we all know the cost for the community college is very less expensive. Then after 2 years, then you can transfer that credits to the state colleges. So I've seen kids have done that also to minimize the cost.
Okay. So so can you elaborate on some benefits of using like investment 29 plan versus a normal brokerage account, particularly for capital gains and state tax benefits?
Yeah, so I think I would recommend, if you ask me to prefer go with either the brokerage type of savings versus 529 saving, I would recommend better go for 529, because in the brokerage account, whatever you invest, and because when you sell, definitely you have to pay the taxes. There is no way we can escape that, even if it's used for education purpose. So that's why if you're 100% sure, if you need the funds for education, then instead of saving and investing under your brokerage account, then do it under the 529 or the Coverdell, those type of accounts.
Okay. Another one regarding some international money gifting for college funds. So this is about receiving money as a gift from Singapore for a college fund. Should it be transferred to my Indian account first and then directly to the US? what's the best way to transfer money from India?
Yeah, so you don't have to send it to India and again do that. You can directly gift from Singapore. And as I said, just create a gift deed and document the transaction for the audit purpose. I think that should be enough.
Sure. Okay. And this is regarding in case of agriculture property in India, which is not subject to capital gains taxes, what would be tax liability when it's repatriated to the US?
Yeah, so as we discussed earlier, so if you haven't paid any taxes in India, then even though as per the law, that is true for agriculture properties, but once you repatriate the funds and you report, so you will be paying the capital gains taxes here.
And what's a social credit and what benefits does it offer?
So the Social Security, it starts the eligibility when you reach the age 62. So once you reach the age of 62, you can activate the Social Security. And right now they'll pay probably 60% of the payout. But if you wait for until the age of 67, then they will get the completely benefit. And also along with that, there is also Medicare. Once you reach the age 65, then the Medicare will be active. Because as long as you work for an employer, you'll have a medical insurance. But if you don't work for an employer, you will not have any medical insurance. So that's why the Medicare will cover your medical insurance part after 65. But again, it doesn't cover 100%, but at least it will cover 80%. So for the remaining 20%, you have to take some supplemental coverages for that.
Okay. Okay. One of the last questions. So this is about when returning to India, you mentioned keeping US term insurance active until obtaining coverage in India. Does it mean we should discontinue the US policy once we have a new policy in India?
Yeah, so that's a very good question. So there are a lot of insurance company, what I've seen, as long as you pay, let's say you took the insurance while you're in USA, and as long as you pay the premium and keep it active, even if you move back to India, so if something happened, they will pay as per the contract to your beneficiary nominator. Okay, so I would strongly recommend talk to your insurance company where you took the insurance and find out if that option is available. Okay, and if not, then keep that policy active. Then as soon as you move to India, then talk to the local insurance agents and then get the another term life insurance in India, the right amount and right coverage for you. Okay, then after that you can cancel it here. But if they really cover it, I would recommend continue to keep this one, because the good thing is you're paying the fixed amount. Because the good thing with the term life insurance is if you took it for 30 years, let's say if you're taking now, the premium is $50 per month, then you'll pay the $50 per month for the next 30 years. But even if you go back to India, so the benefit, right? So the payoff will be in dollars, so that I think you'll have a good exchange rate benefit too. So.
There are more questions. I'll probably take maybe 2 or 3, and then we'll just get to the next one. We just have to keep a tab on the time. I think we are already.
Okay.
Okay. So can a relative, like a cousin, gift 100,000 from India, or is it only from the Indian family member? Does it have to be a family member, or I mean, immediate family member or a cousin?
Yeah, I think it's just either parents or the immediate family members. Yes.
Okay. Okay. So. Okay, can I pay US college fees for kids with US citizenship from India by selling a property in India?
Yeah, you can. No issues. Yes.
Okay, so I'm going to hold here. Let's go through the rest. Then we'll come to this.
Sure. Okay, so the next topic, it's mainly about the taxes, right? Whether saving the business or personal taxes. So if you look at this slide, right, most of them, the families who are making anything above the 90K, if they're filing the married jointly, so you can see their tax rate is 22%. And if the taxable income goes beyond 200K, then it's a 24%. Then if it goes beyond 383K, it's a 32%. So the reason I quickly want to show you quick kind of a demo, because the taxes are pretty high in the US, right? So if you look at this scenario, let's say the husband and wife, each one of them makes 150K, for example. Let's say, so the total is 300K. So look at that. This is for the year 2023. So your taxes, excluding, let's say, the standard deduction, the 25 or 27, so you're paying almost more than $50,000 taxes, right, per year. But there are a lot of legal tools, okay? It's allowed by IRS, so we can utilize to save the taxes. So one of the tool is the 401k, right? So if you do, let's say, pre-tax 401k, which is a tax deferred tool, so for 2023, you can contribute 22,500, right? So let's say the husband can contribute 22,500 and the wife also can contribute 22,500. So what I'm finding most of our Indian friends, they only match whatever the employer does. And if the employer doesn't match, they don't even participate. So I would recommend that's a pretty bad strategy, right? So definitely, if the employer giving something, definitely you sign up because it's a free money. And then also, based on your tax rate, maximize your 401k, whether to your pre-tax or to your Roth 401k. Because in this scenario, right? So let's say you contribute both husband and wife to 22,500. So total, let's say 45,000 per year. And look at that. That reduce your tax liability by $10,000. And if you put that in a long-term perspective, right? So let's say every year, if you're saving $10,000 in your taxes and you put that in S&P 500 index, I'm talking about just the tax savings itself. And if you just repeat that for 20, 30 years, right? So that itself worth $1.6 million. So just the tax savings, right? Investing that tax saving itself can turn into a very big number. So the reason I showed this is just understand the impact of the taxes, how much you're paying, right? So I'm going to quickly go through. There are again, I'm not talking anything illegal or not approved by IRS. So these are all allowed by IRS, right? And you can take an advantage of it. So for year 2024, so you can contribute this 401k to pre-tax the 23,000 right now for this year per person. And if you are above age 50, you can also do catch-up contribution 7,500. And besides that, you can also do after-tax 401k, excluding this pre-tax and Roth 401k, because this after-tax 401k will automatically convert it into mega backdoor Roth that you can do up to the maximum limit of $69,000. Obviously, that excluding the employee contribution and your employer matching. Then besides your 401k, you can also do traditional IRA and Roth IRA. So this is a individual retirement account. So that's $7,000 per person. There is a catch-up $1,000. Even if your income is higher, for example, for married filing jointly, it's more than 230K, you can still do a backdoor Roth IRA. And there is and if your medical insurance eligible for a health savings account contribution, then you can do a HSA, which is a completely pre-tax free, and also the earnings also completely tax-free. And you can, as long as you use the funds for medical purposes. And then that one, the allowed limit is $8,300 for married. And if it's single, it's $4,150. And we already talked about 529. So that you'll get the state tax benefit. But if you're working as a 1099 or corp to corp, or if you have a LLC, S corp, C corp, then you can consider this SEP IRA, self-employed 401k, or defined benefit plan, so that the maximum allowed contribution can go to either $69,000 for SEP IRA or solo 401k, or for defined benefit plan up to $275,000. I provided the IRS link. You can check that, all the limits. Then if you have a business, right, or personal, so my recommendation is do the planning 12 months ahead of it. The issue is everyone rushed to CPA in April to file the taxes. Obviously, they only file the taxes, right? There is no planning involved. So that's why you couldn't save the taxes. So for example, let's say for 2024, the tax due in April 2025, right? So you have to start work on it now. So you have to calculate, okay, what is your projected income? What's your projected expenses? Then work backwards. What strategies you can do, right? Then minimize your taxes. right? And not wait until the tax filing. Then even for 2023, I would strongly recommend find out how much you have to pay to the IRS, assuming if you have a tax due, if your withhold is lower for whatever reason, maybe the W-4 form, if you didn't file it correctly, then you may have to pay back more money to IRS. Then this year, it's going to be, I think, 8% penalty and interest. So you can go to the IRS direct pay website, pay it right away. So that's going to reduce your this unnecessary penalty and tax interest. Okay. Then the strategies, let's assume if you have a LLC, S Corp, C Corp, so then you have opportunity to claim all the eligible business expenses, and you can probably buy a car for your business, and then you can claim the depreciation, and also you can do a big capex expenditures for your whether your software or equipment purchase, and if you did any R&D type of work, so you can also amortize that expenses. And as we discussed before, you can do this SUP IRA, self-employed 401k, or defined pension. Obviously, there are rules are there for every plan, but definitely consider those. And if your kids are helping your business, then you can run a payroll W-2 or 1099. Then you can direct that as a business expense. And if you're an independent contract, if you're paying your medical insurance premium, and you can through S Corp, you can claim it and then direct that. You can buy an electric car, any car through your business and get the credits. And if you have a C Corp, or technically if you hold that stock for 5 years, then you may be able to utilize the 1202 QSBS rule by basically get an exempt for capital gain taxes up to $10 million. And also for kind of the startup, the 83B election, your cost basis, you can keep it, basically declare it and get some tax advantages. And then the brokerage account, I know the personal level, you can only claim up to $3,000 loss every year, but you can set it up under your business account, and that helps to eliminate that limit. Then if you contribute the charities, the 501c3, so you can use that to offset some of the taxes, right? So I kind of quickly go through that. So there are a lot of strategies there. So obviously all the strategies may not work for you, but depending on your specific business and personal situation, again, there's the real estate personal rep status. So you can invest in the real estate, whether it's a long-term or short-term rental, the Airbnb type of rental. And if you can get the REPS status, then you can use that depreciation to offset even the W-2 income too. So so there are a lot of strategies you can definitely consider, discuss with your CPA and tax advisors to get that benefit, right? Or minimize your taxes. And then the move on to the now move how to manage these allocations, right? So we talked about investing in wide range of investments. So just understand what kind of a return and risk you are taking. So if you just keep it in the cash, obviously the risk is very, very low. But the return also, it's not huge. But at least if you right now the money market funds, at least it's getting a good return. Then the second thing is short-term funds. The risk is low, but again, the return is also, it depends on the inflation, right? Then you can also go for long-term bond funds. The return is 3 to 4%. So particularly the people who are closer to retirement or retired, I think this is a good time you probably start looking into this the bond investment, because the last 2 years, because the inflation was way high, the bond fund lost 20-30%. As you can say, that's why the risk is pretty high, because the inflation was very high. Even though the return is 3 to 4%, the principal lost a lot of money. But now I think in the USA, the Fed is going to slowly start reducing the rate, probably maybe later this year. We don't know when, but if that happens, I think it's going to help with this bond. Because if you're retired, I think you probably have to have this decent allocation in your short term to meet your maybe next 5-year post-retirement expenses. So you have to be a little conservative. You cannot be 100% aggressive. So that take a look into that the bond strategy allocation. Then if you invest in the real estate REIT funds, the return 8 to 10%, but obviously the risk is high. But if you take a long-term investment strategy, right, I wouldn't recommend doing these trading in and out day. I guarantee you are going to lose a lot of money in over the long run, or playing with options and cryptos. And so be an investor, not a trader. Be a long-term investor. Control your emotions. The market goes up and down. Whether it's a real estate, stock market, it doesn't matter. Follow the discipline, save consistently, always spend less than what you earn, right? And then only you'll have money to save. Then control your emotions, be a long-term investor. I think you will do fine. You don't have to worry about anything. And then you can also invest in the equity index funds like the S&P 500 or the total stock funds. The returns are 8 to 10% annualized return. Again, I'm talking about the long run. Every year it will fluctuate. Like if you look at last year, the S&P 500 was like 25% return, right? But the year before it was a negative 20%. Like that, the returns will keep changing. But if you look at the long-term annualized return, it over 10-year, 15-year, 30 years, it can easily you can get 10%, right? Then if for the short term, let's say if you have a cash sitting in the bank which doesn't get any return, I would recommend you can either directly invest in the US Treasury, the I bond like $10,000, or you can put it in the T-bills, which is similar to CD, or you can put it in CDs, depending on your cash flow needs. So you can choose the maturity accordingly. So the good thing is it's a principal safe, up to 250K. It's FDIC insured. But right now the returns are pretty good. You can easily get 4.5 to 5%, more than 5% right now. Then the other investment strategies, you can also go for real estate investment. But again, make sure that do the due diligence. Either you can directly invest in the real estate. In that case, make sure that the cash flow what you get through the rent is enough to break even, because you do not have a negative cash flow, because you cannot support that, right? So you have to do that math to make sure that, and you have to be very patient. And there are a lot of due diligence you have to do when you getting into the real estate. But again, in the over the long run, it's one of the good asset class because it produces assuming if you could find stable income properties, and it help with your taxes because you can claim your depreciation, and you can minimize the liability. You can buy it through LLCs, and you can defer the capital gains through using the 1031 exchanges. So there are a lot of different ways you can be tax efficient with the real estate investments. And then again, the another investment strategy is the startup investment. It's not for everyone, but that's something people who are familiar with this, you can invest the startups. You don't have to invest a huge amount, maybe 10,000, 20,000, small amounts, but there is a 95% chance all the startups fail, but the 5% can win, and then it will recoup all your losses and still make a decent return. Okay, so this is another strategy you can consider. Then move on to this is our final topic, post-retirement. So this is for the people who are retired already. So the one important topic is the record minimum distribution. So all the funds which are under the tax deferred accounts, right? As per the IRS, so recently part of the Secure Act 2.0. So based on your birth year, your RMD age will be decided. So if you are about the bond before 1960, probably will be either 72 or 73 years. But if it's after 1960, then the RMD kicks in after the age 75. So I just put the RMD table. So based on the current RMD table, once you reach the age 72 and meet that eligibility, right, then you must withdraw at least 4% of your assets under your tax deferred retirement accounts. Otherwise, you have to pay like 25% penalty right now. Now the IR, before it was 50%, now they reduced to 25%. So that's why the Roth conversion strategy is very, very important. So you have to kind of plan for that after even you retire 59, right, or 60, because the RMD only kicks in 72, 73 above, right? So the good thing is if you look at up to from 72 to probably 83, it's only 4 to 6% only you have to withdraw. Then after that, the percentage increases faster. Okay. Then the next thing is Social Security. So for the people who retire are going to retire soon, so you have some plan when you're going to activate, whether at the age of 62, so your payout will be probably 30% less. But if you more you defer, your payout will increase. But again, it's completely based on your personal situation. So make the right decision. Correct. But I think in the future, obviously, the payout may keep going down because the government is running a huge deficit and their debt is keep ballooning in trillions. I think the Social Security, because the way it's going to work is working, it's a pay as you go system. So the younger generation is paying for the gray generation. So at some point, we may not have the enough younger generation to support the people who are retired. So obviously the government probably will reduce this payoff. Okay. And you can go to either the Social Security SSA.gov. You can open an account. You can immediately see whether you're eligible, how much your payoff is going to be, or even how much credits you have gained so far. You can see all those detail by just opening up your account setup under the SSA.gov. Okay. Then this one I already talked about the Medicare eligibility. As long as you paid the social taxes and the Medicare taxes and meet the 40 credits, you will be eligible for the Medicare. And so this will cover the 80% of your cost. So the other 20% you may have to get the supplemental insurance, but you can activate at the age of 65. Okay. So there is a Medicare Part A, Part B, Part D. So there are a lot of rules underneath that. Okay. Then the another thing is there is also long-term care insurance and also the cost. Unfortunately, in US, this is one of the healthcare costs. It's one of the biggest costs, and particularly the long-term care cost is very, very high, right? As you can see, for the assisted living cost, depending on the state, it can easily from $100,000 per year, right? It's a pretty high. And then finally, the gift and inheritance. I think I talked about that before. I think for 2023, right now, every year you can do $70,000 per kid. Then the lifetime exemption for 2023 is 12.92. I think for 2024 is like about 13 million. Then in addition to the IRS, there is also state inheritance taxes, but only this applicable for the state who has the estate taxes, not all the state. I have it here. So you can see depending on the state, so there is a estate taxes you have to pay for the taxes also. Okay. So I know I try to cover a lot of information. I don't think probably I discuss all the details because of the time constraint, but I strongly recommend. So I created an ebook. I wrote the ebook, so it's in my business website, samatva.us/blogs. So you can please bookmark this link and you can download this PDF. It's probably 30-40 pages. It's a very small book, but whatever I discuss, I captured in very detail, and I also put all the recorded links. We have done 20 plus sessions to all the different Tamil Sangams across many states in the US, and I put those recorded links so you can, whenever you're free. So I have done sessions specific to the retirement planning or business setup or the NRA fund repatriation. And also I put it in my Facebook page, so you can go and you can watch it. And then finally, I recommend Mr. Vijay Mogan. So he runs Investment Insights. He's a nonprofit, and he has probably close to 200,000 followers in the YouTube. And he had done a lot of YouTube videos, short videos, and he covered about this 401k, 520, whatever I discussed in a very simple way. And he has two YouTube channels. One is completely in Tamil and one is in English. So I encourage all of you guys to subscribe and watch these his videos. I think it's very, very educational and informational, and definitely I think it will help you all. Okay. I think with that, I think that's all pretty much I have. So
Thanks, Jay.
yeah.
Actually, I was very impressive. A lot of information. In fact, too much information. Very, very valid information. I think a lot of people are interested. We can see, the questions are pouring in. I thought we can do justice to the questions, but there's so many, right? I mean, I think it'll go for another 2 hours or so. But one good thing is we've captured all the questions. We took a copy and kept it in a note. So we'll do justice by going over and then trying to see if we can address any of those. And if time permits with Mari, we'll try to get some information and post it, right? And some people have asked for few sessions on specific topics that you've covered. We'll also discuss that and then see, potentially what all we can do. And of course, you're always welcome to call him and get more information and help from him directly. And anything that we can do as FETNA, we'll definitely keep it more like a series, but I'll discuss it within the board and we will decide if, something like that, if many people are interested, we will try to help the community with that. Okay, so I'm not going to go into any questions, unfortunately, considering we have to be somewhat reasonable with the time because of what we said, and I think we're already over by half an hour. I just wanted to wrap it up, and I know Vijay, who's the vice president, is in the call from board. I don't know if anybody else is joined from the board. If he's still there, I just would like him to give a thank you note to wrap the session.
மிக்க நன்றி.
Yeah, go ahead.
கேக்குங்களா?
Yeah, I can hear.
ஓகே. என்னுடைய வீடியோ ஆன் பண்ண முடியலையே, அது டிசேபிள் பண்ணிருக்கீங்கன்னு நினைக்கிறேன்.
Vijay, the other Vijay, can you please make him a co-host or something?
Yeah, sure. ஒரு நிமிஷம்.
Vijay Manivel.
விஜய் செல்வராஜ், ஒரு நிமிஷம்.
No, make Vijay Manivel the co-host.
Sure. விஜய், நீங்க உங்க வீடியோ ஆன் பண்ண முடியும்.
இப்ப ஆன் பண்ண முடியும். நன்றி. மிக்க நன்றி ஜெயமாரியப்பன் சார். உங்களுடைய நிதி முதலீடு தொடர்பான அந்த ஆலோசனைகள் வந்து ரொம்ப ரொம்ப விளக்கமா இருந்தது. நம்ம நிறைய செஷன்ஸ் இந்த மாதிரி பார்த்துருக்குறோம், ஆனா இவ்வளவு டீட்டெயிலா வந்து இது வரைக்கும் யாரும் பார்த்தது இல்லைன்னு நினைக்கிறேன். நான் நிறைய என்னதான் வந்து கடந்த காலங்களில் லாஸ்ட் ஒரு 5-7 இயர்ஸா நம்ம ஃபாலோ பண்ணா கூட திருப்பி இந்த மாதிரி செஷன்ஸ் வந்து பார்க்க தோணும் எல்லா விதத்துக்குமே. அது எந்த ஏஜ் குரூப்பா இருந்தாலும், ஈவன் 85 இயர்ஸ் ஓல்டா இருந்தா கூட அதை பார்க்கறதுக்கு தோணுது. ஏன்னா புதுசா மாறிக்கிட்டே இருக்கிறதுனால இந்த டீட்டெயிலா நீங்க சொன்ன இந்த டிஸ்கஷன்ஸ்ல இந்த ப்ரெசன்டேஷன் வந்து ரொம்ப ரொம்ப இங்க உள்ள அனைவருக்கும் ரொம்ப உதவியா இருந்தது. இதுல இருந்தே தெரியுது உங்களுக்கு எவ்வளவு இந்த இதுல வந்து எக்ஸ்பீரியன்ஸ் இருக்கு அப்படிங்கிறது எங்களால பார்க்க முடிஞ்சது. நிறைய கேள்விகள் கேட்டிருந்தாங்க, பட் எல்லாத்துக்கும் உங்களால பதிலளிக்க முடியாது நேரம் கருதி. அதனால மற்றவர்கள் உங்களுக்கு ஏதாவது கேள்விகள் இருப்பின்னு வந்து ஜெயமாரியப்பன் சார் அவங்கள வந்து நீங்க ரீச் அவுட் பண்ணுங்க. அவருடைய இமெயில் ஐடி, வெப்சைட் எல்லாமே கொடுத்துருக்குறாங்க. ஒன்ஸ் அகைன் ரொம்ப ரொம்ப தேங்க்ஸ். இந்த விளக்கப்பூர்வ அறிவு, இந்த விளக்கமான இந்த ப்ரெசன்டேஷன்ஸுக்கு வந்து ரொம்ப நன்றி. இந்த கூட்டத்தை ஒருங்கிணைத்த எழிலன் அவர்களுக்கும் அப்புறம் தொழில்நுட்ப குழுவிற்கு உதவியாக இருந்த விஜய் செல்வராஜ் அவர்களுக்கும் மிக்க நன்றி. நன்றி.
Yeah, once again, thank you, FETNA and all the board members for giving this opportunity. Nandri.
Thank you.
Thank you. Thank you. Bye.
அனைவருக்கும் நன்றி.